All right, so you're looking into those retirement income strategies, right?
Mhm.
Trying to make sure things are set without, getting lost in the weeds. You sent us some stuff on the standard Keystone Index 10 fixed indexed annuity.
From Diversified Insurance Brokers.
Yeah, exactly. So our mission for this deep dive is to break this annuity down.
Get to the nuts and bolts.
For sure. The nuts and bolts, the key features, the potential benefits. Really going to focus on the main thing here. Protecting your principal, but still, having a chance to see some growth tied to the market. We're working off the material from Diversified Insurance Brokers.
Sounds good.
So to kick things off,
Yeah.
what is this Keystone Index 10 at its core?
Well, you can think of it like this. It's a single premium deferred fixed indexed annuity. Basically, you make a one-time deposit, and that money is designed to grow over time.
Okay, a single lump sum.
Right. And what makes this interesting is that growth potential is connected to how the S&P 500 performs. But, and this is key, there are some safety measures built right in.
So there's that market link. But I'm looking at the documents, and it seems like there are a bunch of different ways they could calculate your interest.
Yeah, they do give you choices. That's one thing that stands out. You get to pick how that potential interest is credited.
Okay, options are good.
Right. So you have three main strategies, all tied to the S&P 500. The first is called the annual point-to-point capped strategy. They basically look at the S&P 500 at the beginning of the year and then again at the end. If it's gone up, you earn interest based on that increase.
It's straightforward enough.
But there's a cap. You can only earn so much in any given year.
So even if the market explodes, your gains are limited.
Yeah, exactly. You're trading some potential upside for more security. Could be a good fit if you really want to prioritize protection.
Especially in a volatile market.
Yeah, for sure. Now, there's also the annual point-to-point participation rate strategy.
Okay, so point to point again.
But this time, there's a participation rate. Right now, it's set at 54%. So let's say the S&P 500 goes up 10% over the year. You would get 54% of that gain as interest.
So 5.4% interest in that example.
You got it. And then the third strategy is the annual monthly average capped strategy. This one's a bit different. They track the S&P 500 each month, take the average of those values, and that's what your interest is based on. And again, there's a cap on how much you can earn.
Interesting. So 3 ways to sort of ride the market wave.
Yep, different levels of risk and potential reward.
But what happens if the market takes a dip? What kind of safeguards are there for my initial investment?
Right, that's a big one. Well, this is where the fixed indexed annuity comes in.
Okay, the safety net.
Exactly. Across all those S&P 500 strategies, they guarantee a minimum interest rate of 3%. You're going to earn at least that much no matter what the market does.
Yeah, that's good.
They also have a fixed interest strategy right now at 4.6%. It's just a fixed rate, no market link at all.
Gotcha. So your money is at least growing a little bit.
Right. And it's really important to note this. Your guaranteed minimum annuity value, that's 100% of your original deposit, right?
Minus any withdrawals.
Minus any withdrawals, right. And that value compounds annually at that guaranteed 3% rate. That's like your absolute floor. No matter what, you're guaranteed at least that much.
So worst case scenario.
Kind of, yeah. But there's also this minimal contract value. Think of it as like an extra layer of protection. That's 87.5% of your premium.
Okay, a little bit less.
But it also grows at 3% compounded annually. Now, after any surrender charges, if this minimum contract value ends up higher than your guaranteed annuity value, you'd get the higher amount.
Interesting. So depending on how things shake out, you could potentially get more than the guaranteed minimum.
Exactly.
Now let's talk about getting to your money. What if you need to access some of those funds before retirement?
Okay, so there are ways to do that without getting penalized. From year one, you can withdraw up to 10% of the annuity value every year.
So that's 10% of the total value, not just your original deposit.
Right, the total value. And you can take that 10% as one lump sum or spread it out throughout the year.
So some flexibility there.
Yeah. They also have provisions for what they call qualifying events. Like, let's say you get diagnosed with a terminal illness or you need to move into a nursing home. In those cases, you can withdraw up to 25% without penalty.
That's important to know. So those are some of the exceptions. But what about if I just want to take out more than 10% for any reason?
Well, if you go beyond those penalty-free amounts, you're probably going to run into surrender charges.
Especially in those early years, right?
It starts at 9% in year one, then it goes down gradually, reaching 0% after year 10.
Okay, so the longer you hold on, the less you lose if you need to tap into it.
Right. They also have a rule about systematic withdrawals, but you can only do those from the fixed interest strategy. And there's a limit, just one penalty-free request per year. So it's really set up for that longer-term growth.
Gotcha. Got to be patient. But there is some flexibility. So who's this type of annuity typically a good fit for?
Well, in terms of age, it's open to people from age 0 all the way to 80. And the initial investment amount can range from $10,000 to $1 million.
$1 million. That's a lot of money.
Mm-hmm. And sometimes, they might approve even higher amounts. Generally, the owner of the annuity and the person who will eventually get that income, the annuitant, they have to be the same person, unless, of course, it's held in a trust.
Right, makes sense.
You can also hold it in a traditional or Roth IRA. But if you're thinking about the IRA route, you've got to talk to a tax advisor. Make sure it fits with your whole retirement plan.
Good advice.
Yeah.
So who's actually behind this product?
This one's offered by Standard Insurance Company. They've been around a long time, very established, with a solid financial foundation.
A company with some history.
Mm-hmm. And Diversified Insurance Brokers, they're the ones helping folks understand and access products like this, help people reach their financial goals.
All right, so taking a step back, our deep dive into the standard Keystone Index 10 reveals an annuity that's designed to keep that initial investment safe.
Secure.
Secure, right. And then on top of that, it offers different ways to potentially grow that money, linked to the S&P 500.
Yeah.
Plus, you have some options to access your funds if you hit a bump in the road.
Yeah, hitting those key points, you have that guaranteed minimum growth, the different ways to participate in the market, but with some guardrails, and then those safety valves to get to some of your money if unexpected things pop up.
So our final thought for you as you're considering everything we've covered about the Keystone Index 10, how well does this balance of protection, those guarantees, and the potential for market-linked gains, how well does that align with your own risk tolerance?
And your timeline, too. How long until retirement?
Exactly. And thinking about those interest crediting strategies, you've got the capped annual, the participation rate, the monthly average. Which one feels right for you? Which one matches your investment philosophy, and why? Some things to chew on as you keep exploring those retirement income options.
It's a journey.
It is a journey.